Good morning, everyone, and welcome. My name is John D'Antona, and I'm the Director of Marketing here at CAPIS. Welcome to our virtual panel, Transition Management Analytics, What Really Matters. CAPIS would like to thank all of you for taking the time out of your busy day to spend with us. We hope you find the following information in today's panel useful. At the conclusion of today's panel, there'll be a brief Q&A session. So please type your questions into the Q&A function of your Zoom, and we'll do our very best to get to them and answer them promptly. And now, of course, before we begin, the legalese. The opinions expressed by the featured speakers do not necessarily reflect the views of Capital Institutional Services, CAPIS, any CAPIS ownership, or any CAPIS management not providing said opinions. Any comments and/or information presented within this presentation are for the sole use of institutional investors. Nothing in this presentation should be construed as an offer, invitation, or recommendation to sell, or a solicitation of an offer to buy any securities that might be mentioned. And now, on with the panel. I'd like to turn it over to our moderator, Ben Jenkins. Ben?
Thanks, John. It's such a dramatic way to start a webinar. So what we're going to do this morning is just do a quick round of introductions for the team of panelists that are on the phone, and then we're going to just jump right into the comments. So starting with myself, Ben Jenkins, I'm Director of Sales for Transition Management here at CAPIS. I've been doing transition management for nearly 20 years, and really looking forward to today's webinar to really talk about how reporting matters at the post-trade and pre-trade level. I'm going to have each panelist do a quick introduction, and then for our consultants on the phone, if they can discuss briefly their role in the TM selection process. Brian, let's start with you.
Sure. Good morning, everybody. My name is Brian Gibbs. I am Senior Vice President here at Capital Institutional Services, and I'm Manager of Transition Management. I've been here since 2003. Have a lot of experience and looking forward to this discussion today.
Tom, why don't we go with you next?
Sounds good. Good morning. My name is Tom Schoenbeck. I'm an associate partner with Aon. I have over 15 years of investment consulting experience. Probably the last 5 or 6 have been largely focused on leading our transition management team here at Aon. So I'm based out of Chicago, and technically I'm responsible kind of for oversight of all our clients' transition activity here in North America and EMEA. Just to put a number on that, we see roughly 1,000 events globally. And in my role, we're responsible for the selection process for clients when they go out and engage a third-party transition manager, as well as having oversight on the actual implementation of transition events. So kind of a consulting / research role. We work with our advisory clients and then also our OCIO clients and OCIO funds, excuse me.
Great. And Phil?
Yeah, hi. Good morning, everyone. I'm Phil Jandora. I'm with WillisTowersWatson. I have a similar role to Tom. I'm on the trade management group with the WillisTowersWatson. I'm Associate Director. I've been here for about 4 years now, and I'm also, what part of my responsibility is to part of the selection process for transition manager providers and researching them and offering, guidance to our delegated and advisory teams.
Wonderful. So we're just going to jump right into this. We only have about 30 minutes today before we get to the Q&A piece, and want to make this kind of a fun conversation for all. So from our perspective, when we did some prep work and we were talking about this amongst the group, we all recognize that TM reporting can be very overwhelming. The purpose of all the information, all the reporting that a client gets, we think, is to support and frame the strategy and the estimates that you see in the pre-trade and to validate the results you see in the post-trade. So our goal today is just to talk about how reporting can and should support a client's experience for transition management. And we're going to start a little bit differently than maybe you would think. We're going to start with the post-trade first. So stick with us. We're going to go right into Brian leading us off with some thoughts around the post-trade. And Brian, I'm going to go ahead and share the graphic that you wanted me to.
Perfect. I like how we added a little bit of drama to the mix here with the start at the end portion. But so, yeah, really, we're beginning this conversation where we end an event because beyond the cost, the story matters. And I think that's the thing that we're trying to drive home today. We really want to highlight that the strategy and implementation are important, and really in the same breath, so is a transparent analysis that can be understood. And so for a client or a consultant, the understanding of the process is really key. And that's part of my job as a provider, is to make that known. And so, from my standpoint, whether it's, the conference calls, the pre-trades, the post-trades, the trading of the event, that's all things that are in my frame of reference. And so know that the point of this webinar is for me to provide a point of view from a transition manager provider's standpoint, and to remain neutral. But that said, we're going to be looking at graphics from our own pre and post-trade analyses, just because, well, we built them and we own them. So, so if we start really with this page, this is a post-trade example, because it drives three main things. This is an intraday chart that looks at how much we sold and bought every 10 minutes, as well as what the portfolios did and the overall cost. I'm not going to get into the nuts and bolts really of what this chart is, but I think this shows kind of the level of the detail that a provider should be giving, so that the post-trade cost result is understood. And also from this standpoint, we can actually work backwards into later the discussion will be how a provider should attack a pre-trade analysis. So from this, the three main things that should be able to be known, understood, are really the one, what is the benchmark? Two, did the provider actually do what they said they were going to do? And the answer can be no, because we all know that the markets are living, breathing, active environments. So there should be some adaptation relative to a strategy. But the fact is, if something was changed, then there should be probably some communication of that throughout the actual trading of the event. So none of this should be a surprise. And then three, do you see evidence of trade execution with some sort of thought that controls risk, or was this result simply due to lazy trading or making some big bets that ultimately we're, as a transition manager, we're not really supposed to be doing? Our job is to control risk. Was the result basically just because of market movement and chance? So this ultimately is really the starting point to understanding and assessing performance in our opinion. You can always drill down into the individual names from there, but ultimately I think from a client and consultant standpoint, it's always starting at that 30,000 foot view. And can you see actually some resemblance of the strategy that we said we were going to do in the actual results and the data? So I think this is kind of a place where I can kick it off to Tom and Phil on some aspects that they think about when they're trying to look at post trades and what's important to them.
Right. Thanks, Brian. So this is Tom. I can jump in. And, like you said, the post trade, I think it's a very, important check, right, as part of a transition to really, take a look at it and how do you evaluate the actual transition event. So from a consultant standpoint, we use the post trade to really look at cost, right, validate the results, how do they compare to the pre-trade, right, what your transition manager kind of put in front of the client, what helped make you decision and select them, going forward. What did costs look like? Were they somewhat in line? Were they out of line? If they were out of line, can we really dig into, what drove that? Sometimes, from a consultant or client perspective, you really might want to focus on one number. How did we do, right? How did we compare to the mean? Did we fall to the right or the left? Everyone wants to be kind of close to that center estimate. But, and from my seat, we see a lot of events that, might fall to the right or the left, and our job as a consultant is to work with the transition manager and the client to really dig in, what drove performance. What, as you mentioned, Brian, was it a market event that might have caused the transition manager to, trade faster during a transition event? Was there unexpected news that came out on an individual position that, you made a call to sell that earlier than expected or get, 100% completion early in the morning? So, I really think time spent on a post trade is important because it really helps you kind of validate, how did this implementation go? Was it consistent with our expectations? And then really dig into what drove cost, right? Just because you're on the right side of the mean where performance was favorable, that doesn't necessarily always mean it was a good thing. Was there an issue with trading? Was cash, uninvested during the transition period that, benefited, if the market sold off that day? So we like to, look at the post trade from a high level, one, validate, did things go well? What drove performance? And if there was an issue, really dig into, the numbers and see, what arose. I mean, it's pretty rare that we see, strategy deviating from what was proposed prior to an event, but, it's important to make sure and kind of hold the transition manager accountable for how the implementation went.
Yeah, I agree. Pretty similar, just that, I think if I wanted to put an analogy to it, I would kind of think of, having a renovation project at your home, and you don't really want to take pay the bill, contractor gives you, the final invoice. You don't tuck it away in a drawer. You want to look at that invoice. You want to go through it line by line. Did they do what they said they were going to do? Did they, did those costs from the quote, are they pretty much in line with, your expectations on that final bill? And if not, you're going to want to ask questions about it. So there's not much difference there in terms of the transition manager. Yeah, you're right. You're not going to be surprised when that final post trade comes in. You're going to get updates from that transition manager throughout that transition period. I mean, they're going to be, every transition has their own time period. Some can, last a day, some a few days, some a week, but you're not, let's say it's a week, you're not going to remember if there was an abnormal trading day 4 days ago in terms of, putting everything together. So that post trade is really a way for you to take a holistic view of everything that happened, sit down, take a look at it, and, identify some of those things that Tom said, the cost. You're going to want to look at the cost, where you fell from the mean, good or bad. If your positive cost doesn't necessarily mean it was good, it could have opened up additional risks. So you still want to ask those questions. If you don't want to just take your report and see that, oh, I followed the right, it was this was positive, that's great, way better than expected. But you really want to challenge and ask those questions, because that could have opened up a risk somewhere. And then really just seeing, was everything done that they said they were going to do? And if there were any deviations, hopefully that was explained along the way, and you're just not finding out about it at the end.
Phil, I got to say, we didn't prep on that example. I really like that. One, because I've been actually doing some renovation projects at my place over the last 18 months. Not too surprising. And I've gotten caught on the same thing, right? Where you don't throw it in a drawer. You want to wait. Why did I get this extra $100 charge here? What did you do? So I'm gonna steal that. Absolutely. Yeah. One of the things that when you guys were talking, I mean, again, we're only showing this one screenshot, and I think the interesting thing about it from all of us, right? Whether we're the provider, whether we're the consultant, is around that experiential element of it. And connecting the dots, right? So I think a lot of what the post trade is for all of us, I think, is just validation, right? We've gone in and we've put all this work into it. We've implemented everything. We want to make sure that the client, who again doesn't do these very often, right? Tom said his group does 1,000 of these a year. That's a lot. I mean, that's a lot. So when that's a lot of experience to have. A client might only do one every 18 months, every 2 years. So seeing a report can seem overwhelming. But I think the point of what we're trying to do with these is really make sure that the client walks away going, this was the right thing to do. I felt like it was handled appropriately. And I did manage my risk. It was, this was the right asset allocation decision, and I was able to implement it. So, I mean, I think that's the power of the post trade relative to just throwing it in a drawer.
Yeah, maybe Ben, just to chime in, I should have clarified, 1,000 events a year, not all of them would need a transition manager.
Okay.
but I would say, a lot of times it seems like the post-trade might be an afterthought, right? We spent all this time, a couple weeks planning the implementation, from a client perspective, we're done, right? But I think it's a success story, most cases, right? Where, it deserves a check-in call with the provider to really go over results, have the client and consultant understand, how this event went. Because you may have to answer questions at some point later down the line, which might come up, to be able to really understand, here's how it went. It was a success, and here's why, and here's the post-trade report that validates that.
Yeah. And I think, Brian, I mean, maybe not, maybe from a provider perspective, I think sometimes we like to brag that we did a good job.
Yes. Yeah. I think the natural course of, I probably talk too much regardless, whether it's a good result or a bad result, right? So, but yeah, I think to Tom's point, right, for a consultant to be able to talk to a client about an event, like our job is to make a post-trade analysis that's understandable too. It's not just to throw a bunch of data on a page and then say, here you go, and have fun figuring this out. It's, what is relevant? What were the aspects that we looked at and actually traded on? And then try to give a high level summary, specific to every event, so that when that post trade is given to anybody, really, that they can look at it and be able to understand what they're looking at. So I think that's part of our job too.
Yeah. That's an interesting point, Brian, because when I think about it, I think all of us on this call, it's a little bit of all of our jobs, right? Is to help the interpretation of the data, to help the client understand what happened, and whether it's a conversation, whether it's an email summary or whatever, it's all of our responsibilities to kind of come in and say this is what it was. And so really, that's really the genesis of where we came up with this dialogue today. And so maybe that's a good, unless Phil or Tom have another point. I mean, this might be a good segue into the pre-trade, because that tends to be the part where people really pick analysis apart.
Yeah, ready.
Oh, good. Okay, I'm going to stop sharing the post-trade for a second. And again, what we're doing is we're shifting to the pre-trade. And so what I wanted to do is I was going to ask Tom to just start a little bit with strategy. So again, if you notice today, we're talking about analytics, but we're talking about all the pieces that kind of support the analytics to some extent, right? So for anybody that's ever seen a TM pre-trade or post-trade, there's tons of data that we put out about that. And we're going to talk about that in a second. But let's start with kind of, again, a little bit maybe backwards is we've got all this data. Let's imagine we've got all this data. How does the TM strategy lead to the cost estimate? What's the right number of strategies, Tom? I mean, do we start with one and just assume that everybody should just give their best option, or do you want to see kind of the sausage, right? Do you want to kind of see like the 7 scenarios that we came up with and we dismissed 6 of them? What does that look like?
Yeah, that's a great question and point. I mean, from my perspective, sometimes seeing multiple strategies, right, proposed from the onset can be overwhelming, right, to a client. And from a consultant perspective, I find it's helpful that the transition manager that's selected, maybe bring their best proposed option, right, or maybe another one along with it, and say, here's two strategies that we really thought through. We, ran the analysis on both. Our best thinking would be that, this is the correct path, right? Because sometimes, I find clients can get lost. If someone was to come with them, say, here's 5 or 6 ways we can implement this event. Let's talk through them all, and then, help us, decide which route we want to take. I find it better if here's our best, here's why, here's the data to back it up. Here's what costs look like. I think that's really helpful from a consultant and client standpoint, just the clarity, right? This typically, and I know it was previously mentioned, transitions typically are maybe a once or twice time a year thing for most clients, right? And it can be overwhelming. You spend a bunch of time on the selection process, contracting, you pick your provider, kind of open up the doors to that transition manager where they can speak with all the investment managers, kind of really get all the details that they need to devise a strategy. So So, I like it when a provider comes to us and says, here's what we recommend and here's why. Here's the data to back it up. I think that's helpful.
Yeah. And I guess in that perspective, it just streamlines the conversation. So you don't get lost in the weeds of saying, here's all the stuff that we looked at, but that maybe doesn't fit. You're just saying, let's just focus on the one or two good ideas we have. Like, this is what works.
Exactly.
Yeah.
Yeah. Here's what we recommend. One area that I see, some hedging, right? That comes up a lot. Should we implement a hedge? If it's a trade that has regional imbalances, here's one way we can do it. Here's the costs and risk without hedging. Here it is with, if we were to implement a hedge. Like, to really have that data in hand and be able to kind of lay that out to a client to help them make their decision, I think, is great and helps with the process a lot.
And I would add to that too, that from a provider standpoint, we can get requests for pre-trade bids on a myriad of level of detail. Like, so, for instance, I, recently have gotten one where it's like, here's some holdings, do a pre-trade. Well, don't be surprised if that's the level of detail you're giving a provider, that they might come up with a bunch of different scenarios because there's just not a lot of guidance given. So understanding that there is a point at which a client wants to be, or a consultant wants to be careful on how much data they're actually giving out, to where it's not too much, but the more guidance you can give to a provider will help you eliminate maybe that cheesecake factory of options that might come at you when it's like an encyclopedia that you're trying to go through, because I think that's just difficult. I think you want everyone's pretty much best foot forward, so that you're comparing those items. I think that's enough from a client and consultant's in terms of workload that you all want to handle anyway.
And it's not necessarily something kind of probably we're going to talk about a ton today unless it comes up in the Q&A, but I think there's a lot to be said for the idea of, we all want, providers, consultants, and I would assume clients want normalization, right? Like, if we can, the more kind of normalized the data is, the more normalized the analysis are, it allows us to really focus on the differentiation points between the providers, and really allows the client and the consultant to make the best selection, if you will. But if we have too much noise out there, kind of to Brian's point, right, that maybe the data is too generic, or we don't have a good understanding of timing requirements or something like that, all of a sudden you do get a cheesecake kind of factory menu like approach. And that's, if you already thought the pre-trade report was overwhelming, wait till you get 7 different scenarios of that same report.
Yeah, it can be easy just to say, I've got this event, I'm going from point A to point B, here's the data, how do I get there? And sometimes, I've seen it where, maybe not all the questions are asked. We're like, well, what are the goals? We ran into a transition where on the advisory side, we were asked to look over a pre-trade report, are they in line? So took a look at it, costs all looked in line, strategy seemed reasonable. I just asked the, advisory consultant, that there was a large duration shift. So I just had asked, is the goal of the client to just turn that duration on right away? Or do they perhaps want a dollar cost average? If they wanted a dollar cost average into that over a short period of time, you could remove kind of that futures. They were going to turn it all on with futures. You could remove that futures cost out. So, they went back, and ultimately the client had decided that, they wanted to dollar cost average in over time. So over a shorter period. So obviously that opens up the, your opportunity cost there by opening up, a longer time period to get into your target. But ultimately, I mean, that, you got to ask the question of, what's the goal of the client? Is it just to turn it on right away? And then perhaps just have the discussion about, well, if the opinion is still, well, you should turn it on right away because the data suggests this, then, that would be, good information to send along.
And where does that sit, Phil, and maybe Tom too? I mean, even with things like the benchmark for performance, right? So when we come up and look at a trade, where does the benchmark conversation come into play, or does it?
I can, I'll jump in real quick. So I think it's important, right, to discuss that early on. And, how you benchmark a transition should, be largely driven by the strategy, right? And the client's goals and, what they're looking to do for this specific event. Are there funds on one side or the other where a market on close trade and benchmark would make sense? Or is this an event that you're going to start first thing in the morning and trade throughout the entire day? Because at the end of the day, a benchmark that's selected is going to kind of drive what that pre-trade estimate looks like, right? So I've, as a consultant, I've run into some issues when a client's going out to bid to a couple different transition managers. You might get, one bid that's market on close, one bid that's implementation shortfall, and you really, it's hard to compare these bids when they're not apples to apples. So I think from a consultant standpoint, I always try to go out to a provider and give them guidance. Here's what we're looking for. Here's the strategy I want you to model. I know it may change, when we actually really nail down the strategy with the client. But for this, let's use this just so, it's easy to compare amongst a number of different players and help a client make a decision.
Yeah. Maybe, and thinking kind of, again, if you think about all these pieces that kind of lead to strategy, Brian, from your perspective, I mean, what's, again, as a provider, let's talk about strategy. How did we get there? And again, if for any of you on the call, assumably most, if not all of you, have seen a pre-trade from somebody before, it's a lot of charts. It's a lot of data. So how do you take all that and come up with a kind of a theory of what the trade's going to be?
Sure. And we've got, a few graphics for this too, but I think the main thing, and it's already been addressed, is that we want to make sure that from a client standpoint that the goals are taken into consideration. I mean, that drives a lot of what we talk about in terms of time frame. If we're going to say it's a 7-day trade, but we're only given 5 days, what do you do with that extra tail? So those things need to be considered. And again, it gets back to what I was talking about earlier, is if we're just kind of given like, here's some holdings and give us a pre-trade. Well, one of our main questions would be like, well, what's the target side? Are you just going to cash? Are you going to a passive fund? Or is there a need for interim exposure? We always want to look at things holistically for where the client ultimately wants to go with their assets. So, but yeah, to come up with that pre-trade cost number, I mean, there's a couple different aspects that we're looking at, and I think so. These graphics, they're ordered. I don't know if I would say like 1, 2, 3, 4 in terms of ranking, but there is kind of a top-down approach that we want to look at for these things. So if we look at the first graphic, the first graphic's liquidity. I mean, I think this is probably the most talked about and probably the most well understood aspect of any sort of risk component for a transition. Obviously, the more liquid, then the more time is needed to be able to mitigate that risk. But also, we know that, look, the market impact versus opportunity cost risk, that game of like in the snap of a finger, I would love to be done. So opportunity cost risk is 0 in a transition under that scenario, but market impact is huge, right? On the flip side, if you take forever, then market impact is low, but you are opening yourself up to a ton of opportunity cost risk with any sort of movement. So we're trying to assess that. Like we want to know what's the pace we need to participate on this to be able to get the best result. And so while the first graphic's market impact, AKA liquidity, the second one really drives into the opportunity cost component of this. So like think if you've seen a pre-trade where you've seen like the bell curve, right? A normal distribution of cost results. That width of that curve is really driven by this second graphic of how well the portfolios perform relative to one another. If it's really tightly correlated, well, then that helps us, right? As a provider, we know that we can take maybe a little bit more time. We can focus more on market impact and some of the other aspects that contribute to risk. And if we see wild swings, then we know, okay, we need to be more aggressive. Because maybe, yes, we'll have some more impact, but the real risk of this is that it could get away from us and because of opportunity cost risk. And so a lot of that risk will come from different exposures. And so if we can get to the next graphic, the third graphic here, so the one at the top, this is something that CAPIS that we look at. So whether a provider trades strictly on staying market neutral or sector neutral, or if it's beta, or if there's whatever aspect a provider wants to focus on, any sort of over or under exposure of the legacy relative to the target is risk. And so one of the ways that we can talk about this is that for industrials in this example, it's most prominent, it's the largest bar that you see on the chart. So you'll see here that the legacy holdings are a lot more than what the target wants to own. So of course there's risk there, right? If you're just to VWAP that out and let it go into oblivion, then there's some risk that can happen throughout the day. So should we tackle that first? Another aspect would be contribution to risk. So this is something that we haven't really touched on, but technology, you can see the line part goes very high there on technology, not as high as on industrials. We kind of would expect that maybe intuitively, but here this actually shows us that, okay, there's something going on in technology that we need to be aware of. And there might be some single stock risk there that needs to be addressed. But it's not an either or situation. It's a and both scenario that we're trying to look at there. And then kind of the final graphic, I think so many times we can just kind of throw market capitalization as like a fill-in. It just kind of feels that way. But in this instance, you can really see, yes, this is a large cap trade, but look at contribution to risk. You can see that in super large cap names that something is going on there because, yeah, most of our risk is there. Now, that doesn't mean that something's illiquid there. That just means that there's something in there that's highly volatile that needs to be addressed. And I think from a provider standpoint, I can get laser focused on sticky, hard to trade items, high ADV, maybe ADRs that we have to convert, trade in local markets. Like there's a lot of aspects that we want to focus on, but you never want to focus so much on those things that you let something like Google hurt you that could have been finished early, that you just let drag on because you're focusing on the other items. So I think in this case too, we're trying to find the items that are really potentially going to hurt us the most. And all of that rolls up into the overall cost number that both clients and consultants, use to compare between providers. And so again, I think the tagline of this is like beyond the cost, the story matters. And so being able to trust the strategy and the process that each provider wants to implement will really allow you to make the best choice.
So if, and we're a couple minutes over, which is probably a good thing, I would say. But let me wrap up with one last question for the group before we move to a Q&A session. And again, if we're going with this kind of beyond the cost theme here, so this is more for Tom and Phil. If beyond the cost, right, beyond the commissions, how do you assess the best provider, right? We've taken this time today. I would imagine there's a couple of people on the call that are like, yeah, just tell me that one answer. So how do you do it?
I could start, Tom. So you want to set yourself up in a position where, you're prepared ahead of time. You don't want to be searching, for a transition manager and who best fits your needs once you know you have a transition manager event going on. You want to do the pre-selection, the due diligence, right? Because if you're doing it at the point in time you have an event, well, then that's kind of opportunity cost there. You're opening up a longer time from getting from point A to point B there. So, for us, we'll do the research and due diligence, up front, and we'll look at different providers and assess them on, their overall business and process and systems, the people they have available, clients. And from there, we'll kind of just get it down to a preferred list. And, as requests come in and, we'll provide guidance on which manager we feel would be, of our preferred managers, we feel for each event would be, good for that transition. We would recommend that. Sometimes, you come into an event that's pretty complex and you suggest maybe reaching out to a couple different providers, to get a sense of different strategy ideas, and you may see different costs as well.
Right. Yeah. We approach things very similar to Aon. Same way, preferred lists of providers that we've done due diligence on and would recommend to clients and kind of steer them in the right direction based on complexity and overall scope of a transition event.
Cool. Well, good. Thanks, guys. I appreciate you spending a little bit of time with us today. And two, John, I'm going to kick it back over to you to see if there's any cues that we can answer.
Thank you, gentlemen. One question that came up was, how does a consultant decide what is the right information to provide clients with?
It's a good one. Phil, I'll start and feel free to chime in. I think as a consultant, it's our job to kind of digest the data that comes back from the transition manager and put it, into a format that is, relevant and raises kind of the points that a client would need to make their decision, right? So I know we've spoken a little bit just how, you look at a pre-trade report that might be 10, 12 pages long with a lot of, information. How can we go through that, kind of highlight the important points? Like to Brian, you mentioned like the technology sector. Here's a risk you should be looking at. The trade strategy that's selected should mitigate that, right? And to really, help clients understand, X provider is the best for the job. Here's the strategy that we think makes the most sense. It's going to keep costs as low as possible and mitigate risk during the event. So, I do a lot of kind of summarizing, right? Taking the pre-trade, putting it into a format that a client can make a decision on.
Phil, anything to add to that one?
Yeah, sure. Pretty similar. I mean, I guess depending upon where it comes from, we don't necessarily, if it comes from the advisory side, we don't necessarily get the, we're not really asked to like look deep into the report. As I mentioned in an example I provided earlier, it was more along the lines of, can you provide some, guidance? Does this strategy seem reasonable? Is the cost in line with expectations? Not really going into the, digging in deep into the weeds on that.
Okay. I have a redirect on this too, just in case the question that came from the audience was in relation to maybe something I said. I think there might have been a question on, okay, Brian said, if he gets just holdings, then he's going to give a lot of different, strategies involved, because it's all based upon what's feasible. A lot of times how you work with a custodian, or if it's an active to passive event, like we just don't know all the variables. So we have to present, these are options based on what it actually exists that's relevant to that event. So the question might be, also regards to how much information should I give to CAPIS or to a provider, so that we're protected from how much information we're leaking out to the market, but also so that providers can give a good response that I can, I or the consultant can digest. Does that make sense? I think that could be the question.
Well, interestingly, I think that was Brian and I probably thought the same way about that question, and then Tom and Phil, being consultants on the call, thought about it the same way. I think from a provider perspective, that's one of our biggest concerns, is balancing kind of the information distribution and saying we want more at the pre-trade stage, with a client or consultant saying this is all I feel comfortable giving you. And I think a lot of that goes, we didn't even touch on it today, but a lot of that goes to the trust, right? So Phil and Tom both talked about having kind of approved panels of transition managers. That's a pretty easy way to start. Get to a point where you trust the providers that you want to use for an event, which kind of should go without saying if you're about to give a provider a big transition event to do, but then be able to give them as much information as possible, because it helps make the conversation more relevant. It aligns expectations. And I think, again, as a group, an industry, a provider, a client, whatever, consultant, we're all better for it.
Sure. Yeah, and then on the delegated aspect, where we're given that ability to sort of make that decision on behalf of the client and what's best in terms of what questions we want to ask and what questions we want to drill into, and also understanding we have trust with our providers, and knowing what information that they need and being able to provide that to them.
Yeah.
But we don't see a lot of the on the delegated side, a lot of the I want to know the nitty gritties on the client end.
Yeah. Okay. I think we killed that question. I think we went in it from every which way we could. So, John, do we have any other questions, or do we just end on a high note?
As much as I would like to end on a high note, I do have one other question for the panel. This person writes, historically, it seemed a lot of clients would only focus on pre-trade. Now you've got post-trade analytics. Is there a trend now to focus more on this aspect post-trade than before?
Yeah, I can chime in here. So, I think it is important, right? And I have seen, clients become more interested in post-trade reporting. Analytics have gotten better. There's more data that's available to clients. And I think from what I've seen, a lot of the approved providers that Aon works with, they've invested pretty heavily, right, in their analytics, in their tools, in their reports to be able to share that information with clients. But I agree. It used to be, historically, a lot of time spent on the pre-trade, and, commissions always typically would drive decision-making a lot early on. And, I think at Aon, we've tried to get clients to kind of, focus on, more aspects, not just that explicit commission number, right? It's usually the smallest component of cost in an event, and not something to solely make a decision on.
Tom, before anybody else jumps in, kind of an interesting point you just made there. I think I never thought of it this way, but I think historically it was kind of the 80-20 rule, right? You spend 80% of the time on the pre-trade, 20% at best on the post-trade. But maybe some of that comes from the fact that if people were making decisions mostly on the commissions, the post-trade conversation is pretty much, were the commissions the number I told you to be at? Okay, I got it. So I'm going to move on like that, because that was the primary decision point. That's the only point of validation. And I think as the market shifted to this more holistic approach to strategy and benchmarking and all these other factors, I think as a group, we all want to spend more time on the post-trade just because it circles back, it connects the dots.
Right. Yeah. I think, we've done a fair amount of education too with clients, right? To just really have them, understand the pre and the post-trade and kind of the value that they do provide, during the transition process.
Phil or Brian, anything to add to that one?
I don't really have anything additional that Tom, kind of didn't already mention. So,
I personally, I like the post-trade part more than the pre-trade part, just because I think it's the culmination of work, right? It's everything, the conference calls, the goals, the pre-trade analysis, the operational logistics, all of it that you hire us for. Then ultimately, what's the result? And the charts help tell the story. We've said that multiple times, but I think as the level of detail in the post-trade has increased, and ultimately, again, I think providers as a whole have gotten better about how they communicate the data, instead of, because I've seen some that are just like, here's a data dump, and here's the post-trade. And I think that would, if I was a client, I would only want to spend 20% on that, because it would just make my head spin. So like as someone that's done this for almost 20 years, I've seen some of those even currently, and I'm just still like, I don't even know what's going on here. So, I think that's part of it too, is we've gotten better as an industry and just communicating that to consultants and clients. I think the conversation can go deeper.
Yeah.
Yeah, you wanted to tell a story, and you want some consistency there, right? From report to report as you see them. You don't want to see different formatting going on. So, you want that information to sort of be like in layman's terms, so that everybody can understand what's going on, and not be too technical so that it can't be understood.
Yeah, it's a fair point. John, anybody else sneak a question in the last couple of minutes? I'm assuming not, but let's be open.
No, there were no further questions.
Okay.
So
Okay.
bearing that in mind, this concludes our virtual panel, Transition Management, What Really Matters. I'd like to take an opportunity to thank every one of our panelists for taking time out of their busy day to be a part of this production. Also, CAPIS would like to remind viewers that we will be having our October research call, and it'll feature market policy partners on October 21st at 11 a.m. Eastern Standard Time. Again, thanks everyone for joining us, and have a great trading day.